with Chapter 2, we're going to get to our last module, which will cover Learning Objective 4. And as I noted at the end of Module 3, we're now going to have an intermediary step in moving from the ledger to the financial statements. And that step is using the trial balance to help us prepare the financial statements. So when we look at the sequence again, let me get you to the whiteboard. When we look at the sequence, we're going to see that we go from the general journal then we post to the general ledger, and now we're going to add a trial balance. And then finally, the financial statements. Now this is the beginning of, and only one of the first few steps. We have a bit more to go to cover what we call the accounting cycle. So this is what our accounting cycle looks like now. And then don't forget, prior to this, the accounting cycle simply looked like the accounting equation. Then it just looked like the ledger, where again for us, our visualization of that is the T accounts. Then we go to the trial balance now, and then to the financial statements. So let's take a look at what we mean by a trial balance. At the end of the accounting period, we're going to list all of the accounts in our general ledger in the debit and credit columns, and this listing is known as a trial balance. After all of the accounts have been listed, the total is taken, and of course, debits should be equal to credits. Now, by doing this, you should note that the trial balance is really nothing more than just a listing of all of the accounts in the ledger in their debit and credit columns. The equality of debits and credits does not ensure the accuracy. So the primary purpose of the trial balance is to prove the equality, not the accuracy of the debits and credits. It only shows us that debits are equal to credits. It is not going to prove the accuracy. There could be some errors in there, which we'll talk about in a minute. Another important point about a trial balance, it is not a financial statement, but it is simply a tool that is used to help us prepare the financial statements. So once again, trial balance does not prove that all transactions have been recorded and they have been recorded accurately. So here's a problem, or here's a list of problems, I should say, that could still be in existence even though debits are equal to credits. A transaction is not journalized, so you forget to book an event. Debits have to equal credits. In this case, there's 0 debit, 0 credit. It was just omitted. The correct journal entry was not posted. So you made a journal entry, never posted it to the ledger. You post the same numbers twice, still have equality. Incorrect amounts. So debiting for $10 and crediting for 10 will balance the ledger, but maybe instead of 10, that account should have been 100. So in other words, let's say you have cash and sales. You're recording a sale, and the sale was for 100, but you only recorded as 10. Obviously, debits are equal to credits, and the trial balance will balance. And then we could have offsetting errors. Again, you can, as we said, use $10 instead of 100, and you make the error in the same place. You could also have other errors in different transactions. You could have errors that might be going to the wrong account. Instead of having sales, you could have credited interest, income, a different type of revenue. So rather than having revenue from sales, you have revenue from interest. So debits can still equal credits, but the trial balance could still balance, and it could be inaccurate. Here's an example of a trial balance for Smart Touch. Now these numbers are given to us. They're taken from the general ledger, taken from the T accounts. And again, it is not necessarily the same example we had. In fact, it's taken us several periods forward. This is now into December of 2014, and I think in the Smart Touch example, we only had a single month of November, and now this is for the entire year. Notice again, like as we've been saying, it's not a financial statement, but it is a tool. You'd have to put the company name, the trial balance, and this is a position, or just like the balance sheet in a way. It's a stock statement, so it's at a point in time. Now again, I just want to make sure that you realize that in here, we're still assuming that Smart Touch has a zero balance of retained earnings. So it's the first year of operations, and Smart Touch does not have retained earnings. And of course, here, debits equal credits, but it just tells us that debits and credits are equal after posting from the journal to the ledger. It doesn't mean it's accurate. And again, these amounts all come from the T accounts in the general ledger. Now, how do we prepare financial statements from the trial balance? Well, again, let's go back here, and you notice that the accounts are listed, balance sheet first and income statement accounts. They could be mixed sometimes depending on various transactions. So if we wanted to prepare the income statement, we're just going to be dealing with the revenues and expenses. So let's go to the next slide, and you'll see that this has been highlighted for us. So all of the revenue and expense accounts, all of the income statement accounts are in fact highlighted in blue. So for the year, and again, don't forget, Smart Touch Learning, name of the company, name of the statement, and this is a flow statement. The income statement is for the 2 months ended. Remember, the company began in November. And once again, remember the order of financial statement preparation. We have to prepare the income statement first. So first thing we do is we just take the revenues, record that, or move that to the income statement, and then we take the various expenses, move that to the income statement as well. And net income for the 2 months ended December 31st of 2014 is $10,008. Now remember, we have to record this in the income statement first because we need this information because it has to go to the statement of retained earnings. Remember, and again, there's no retained earnings here because we just started our business, so we have to move this to the statement of retained earnings. So we need to prepare the income statement first because it's necessary to get net income to help us prepare the statement of retained earnings. So the statement of retained earnings, of course, is next, and information from that comes from the trial balance as well as from the income statement. And then, of course, that ending balance of retained earnings is going to go into the balance sheet. So remember, this is the concept of articulation. Net income from the income statement goes to the statement of retained earnings, and then the retained earnings will go to the balance sheet. So let's see what we need to do in order to prepare the statement of retained earnings. Now again, there's no balance here of retained earnings. So we begin the company on November 1st. There's no retained earnings. Income from the income statement is going to the statement of retained earnings. And again, before I forget, let me remind you that you must have the name of the company, title of the statement, and the period. This is for the 2-month period, December 31st, 2014. Net income for the 2 months, $10,008 from the income statement. And then from the trial balance, dividends were distributed, declared and distributed, and therefore they come out of retained earnings, so your ending retained earnings is going to be $5,800. Now, remember, net income is from the income statement above, and this retained earnings balance has to go to the balance sheet. Has to go to the balance sheet. So the rest of the information to prepare the balance sheet will come from the trial balance. And of course, the retained earnings account, as we said, does not come from the trial balance. It's a very, very important point, and it's going to be true throughout, because the balance in retained earnings on the trial balance will always be the beginning balance, and therefore we have to take the information for the balance sheet preparation from the statement of retained earnings. So any retained earnings, and this is a key point, so any retained earnings that you see on a trial balance at the end of the year is only the beginning trial balance, while the balance sheet needs the ending balance. And that's where we need to have the statement of retained earnings. So once again, when we look at our trial balance, we now can see easily that all of these balance sheet accounts just map right into the balance sheet. And again, it's the company name, statement, and this is at December 31st. It's a static or a stock statement, and therefore we have assets listed, our liabilities. Common stock comes again directly from the trial balance, but the retained earnings is going to come from statement of retained earnings. So that 5,800 comes from the statement of retained earnings. Retained earnings on the trial balance was 0, and it is not used. We therefore have to take this from the statement of retained earnings. And we're not going to illustrate the cash flow statement in this chapter. We'll come back to that a bit later. And of course, although we don't see it here, assets, total of 114.7, have to equal the sum of liabilities and stockholders' equity. So liabilities of 60,009 plus the stockholders' equity of 53.8 will equal 114.7. So the balance sheet will balance. Now, we'd like to move to another topic and talk a little bit more about the formal recording process. And although we won't use this formal recording process for an extended period in the course, it's really important for you to understand how the process of journalizing and posting works, how we have cross-referencing, particularly from an audit standpoint. And again, even if you're not going to become an accountant or an auditor, it is critical that you understand how to trace transactions through an accounting information system. So the T account is an informal visualization of a ledger account. We're now going to look at a more formal recording device, which is the 4-column ledger. And the 4-column ledger has the first 2 columns would be the debit and credit column that is used to record each transaction. And then the balance could have either a debit or a credit column, and that's the other 2. So those are your 4 columns. And of course, there is a balance taken after each transaction is posted. Now, the account numbers are also included. The account number is typically on the top of the ledger account. and there's also a posting reference column, as we'll see. Posting reference column would reference the page of the journal that the transaction is taken from. So it's a cross-referencing system, and this is needed to trace the transaction back to the journal. So when we look at our next slide, we're going to see that clearly when we look at the informal account, it doesn't provide you with as much information as you would had you been using the more formal account. So again, we need to think about the fact that the more formal account has the posting references that I want to go back and highlight. So let's see what those posting references look like. The informal T account, this is the balance of cash, does not have any posting references. We just have dates. Here, in the more formal account, again, the item could be used if you need to explain any transactions, but the posting reference here is the journal page number. So this is journal page 1, general journal page 2. So we can track back to that journal to find the actual entry. So notice it's fragmented. All you see here is the debit to cash for $30,000 on November 1st. But if you go back to page 1 of the journal, you're going to find the entry that we know will debit cash and credit common stock. This is your account number, 101, and that's the general ledger account number. And that's going to be used to reference back. If you look at the journal is going to have, if you go to page 1, you'll find account 101 there as well. If you think about the 4 columns, those are the 4 columns right there. Debit, credit, and the balance columns are also in debit and credit. So when we use the formal journal entries, or the formal T accounts, or the formal ledger accounts, we also have to have posting references in the journal. Each journal now is using a posting reference column, as I mentioned earlier, that you could have a posting reference column, and that will have the journal page number on top, and the posting reference will refer back to the ledger account number. So here's the way our cross-referencing system will work. Let's go back to our initial Smart Touch Learning illustration. So on November 1st, when we started the operations of the business, we invested $30,000 in cash and therefore issued common stock in the same amount, debited cash, credit common stock. When that is posted, the posting reference is the ledger account number. Cash is account 101. So now I know that, and by the way, here's the explanation, owner contribution or issued common stock. And again, this could also, if we normally have this as common stock in a corporation, because there's only one owner here, we're using the owner's name. Account number 101 is cash, and there's the cross-reference. So I know if I go to account number 101, I go to November 1, and I'll find the debit to cash. I also cross-reference back to the page. So this is J1. Make it clear. Sorry. Journal entry is on the journal, page 1. Same thing happens here when we credit capital or common stock. Enter 301 when we post. Before we post, there's nothing here. In fact, if you look at an accounting system and the posting reference column is blank, that means that the entry had not been posted. But then when you do post, you're posting to account number 301. And once again, we're back to the journal, page 1. So we cross-reference back and forth. So that provides us with a very easy way to trace transactions throughout the accounting system. So to summarize, at the end of the period, we're going to have a trial balance. The trial balance is going to be taken from these ledger accounts. If we need to, we could trace the transactions back, because I know that this debit to cash came from page 1 of the journal. I also know that the credit to common stock also comes from page 1 of the journal. In addition, when I look at this journal entry, I can understand by looking at the posting reference column that yes, these transactions have been posted into the ledger account. So formal accounts have 4 columns. We will typically use the T accounts. Now, at the end of the period, to summarize, we're going to prepare the trial balance. We list the accounts, and the trial balance was used to prepare the financial statements. And again, note how the statements articulate. So again, trial balance was given here, and in fact, it will list all of the accounts. Make sure you understand, it's a very important point here, that the trial balance and the balance sheet are not the same. Trial balance simply verifies the equality of the debits and credits. It is not a financial statement, it is an internal document. So the trial balance is not a financial statement. It is an internal document. It is only used by employees internally. It's only designed to ensure the equality of debits and credits. It does not ensure the accuracy. Again, as we said, you may forget to post an item, make an error on both sides that are equal, etc. The balance sheet, on the other hand, is a formal financial statement that's issued to both internal, but for us, we're worried about external users. So a balance sheet is a financial statement. And clearly, balance sheet is not the same, not equal to a trial balance. And finally, to think about the articulation, and we will summarize with our accounting cycle in a moment. Again, income statement first, statement of owner's equity or stockholders' equity, and then the balance sheet. Articulation, income goes to the statement of stockholders' equity. The ending stockholders' equity goes to the balance sheet. So we first prepare the income statement. That number is needed in the statement of stockholders' equity. Once we get the ending stockholders' equity, it goes to the balance sheet. Please remember that the beginning stockholders' equity, this is what is on the trial balance. So we cannot use the retained earnings or the stockholders' equity accounts that are sitting. In fact, this is the retained earnings, clearly. You cannot use that amount from the balance sheet. And finally, to summarize the accounting cycle, and this is up to this point in the course, we have source documents, could be invoices, it could be notes on a note payable, it could be a signed contract that triggers, remember, in order, just to summarize, in order to record a business event or to record an event, it has to be both recognizable and measurable. In order to be recognizable, it must be an exchange of economic resources. And then to measure it, it has to be measured in the dollar. Once you do that, you first go to the book of original entry, you journalize, then you post that to the ledger, listing all those accounts, you have a trial balance, and then you issue financial statements. So this becomes our accounting cycle up to this point. So as it stands at this point through the course, we have gone through the accounting cycle, and that accounting cycle again is going to be posting to the journal, or I should say journalizing first, posting to the ledger, trial balance, and then the financial statements. And don't forget the cross-referencing system that we have on the journal. We have the ledger account numbers, and on the ledger we have the journal page numbers. This is a cross-referencing that we need to audit. It leaves an audit trail. So if we go to the journal, we have the ledger accounts, we know where we can find them. If we go to the ledger, we have the journal page numbers, and we know where we can find them as well.